Thank you for joining our second SISIP session for the month of June. I want to introduce Martin Carette and say thank you, Martin, for coming in to speak to our families again, this particular session on understanding credit. So I'm going to turn it over to you, and without further ado, take
Thank
it
you very
away,
much.
Martin.
Hello, everyone. Nice to be here again. So yes, today we're going to talk a little about credit, demystifying some of the myths about credit, how it really works, just so everyone gets the proper understanding, because there's a lot of misconceptions out there as well. So we're going to cover pretty much everything there is to know about credit. And again, a little reminder from our previous session where we talked more about budgeting. Really, when we start looking at credit, it really starts with that budgeting piece first. So if we don't have a budget, it's rather risky to get some credit because we need to make sure that everything works together. So we're always going to refer back to that budget. And when I talk about budget, again, it's really about the tracking of our expenses, of really knowing where our money goes. So that never goes away. Again, it's the base of everything that we do. So when our next session, we're going to talk about saving and investing. Again, it comes back to our budget. We always need that good budget to start things with. So things we're going to talk about today, we're going to talk about how to manage credit, how to pay off debt, and really understanding how it works, the in-depth side of credit. Again, benefits of this is taking control of your financial future, assist you in achieving your life's goal, helps provide for yourself and your family, being a smarter consumer, and eventually reduce stress, because financial stress is a big one for a lot of people. So it is important to look at. So credit and debt management. Again, I'm a financial counselor. I've been doing this for many years now. I have absolutely nothing against credit. Credit can be a very useful tool, but we also need to understand that it can also be a very dangerous tool. So that's why it's important to understand how it works so we can use it properly to avoid getting ourselves into trouble, because there's always some very tempting things out there. Again, if we have a good budget, we can create plans, and we'll show you some examples of that to make sure that we don't get into that credit trap. First little quiz, did you know that federal regulations say that credit card companies have to ask your permission to raise your credit limit in Canada? That has been like this for quite a while now. I'd say about 15 years ago where they changed that. So banks need to ask your permission to increase your line of credit on any product, which is most of you, I'm sure, have seen this. You go to the bank machine and congratulations, you want us to increase your line of credit. You just click yes. So you're giving them that permission. Again, you are entitled to say no. We don't have to accept these increases. If you're comfortable with the amount of credit that you have at that time, click no. If you ever need it later, they're willing to increase you can always give them a call at that point in time. But again, it's kind of a less pressured way of trying to increase credit, because when there's more out there, then sometimes we spend more, which is why they offer it to us. Again, it is their business, but we are absolutely entitled to say no when it comes to those increases. Couple of quiz questions. 2017, average household debt of Canadians. If you guys want to take the chat and take a shot at this, A, B, or C, we're looking at total average household debt for credit. So we have a couple of answers or guesses here. B, 56. You are a little low. Now, in fairness, this survey that include mortgages, so that it'd bring it up. If we look at the last survey in Canada, when we looked at credit card debt alone for the average Canadian, for every dollar earned, Canadians owe $2.19 on credit. In other words, we owe a lot more than what we make. So that is not a good thing. Although credit can be useful, it's very expensive. So that does come at a cost. So we need to think about those things. Paying your credit card bill just a couple of days after the due date won't affect your credit report. True or false? Give people a chance to give an answer. Yeah, a couple of answers here. False, false, false. Yep. So that's correct. It's false. So late is late. So it doesn't matter if it's one day. That due date is very important. And sometimes we got to be careful too, because we pay online, and you pay on the due date at your bank. Well, the credit card company might not get it to the next day. So that can be tricky. It's always a good idea to pay 1 or 2 days before the due date, just to make sure in case of any delays or anything like that, to ensure that they receive that payment on time. So just a good habit to get into. And if we kind of relate this to our first presentation, it comes back down to, again, making sure we read those bills when they come in, making sure we understand, we know when that due date is. And I'll fully admit, some of these credit card companies, sometimes the way their statements are set up nowadays, they sometimes make it very complicated to even find that due date minimum payment due. So some are very good, some are rather convoluted at times. So again, just making sure you make that payment on time. All credit cards have the same grace period, also known as interest-free period. True or false? We get here, false, false, false. Yep, you're correct. It's false. Minimum grace period in Canada is 21 days. Some banks will go up to 26. That information always is given to you in that little piece of paper called terms and conditions of the product you get. So it's usually 6 to 8 point font, very tiny, very boring to read, that most people don't read. And I get it, but unfortunately, it's very important to read because those are the rules of the product you got. And although most credit cards have very similar rules from one bank to the next, some have their own little twist of things. So as hard and as boring as it is to read those terms and conditions, it is important to look because it will tell you what your interest rate, what your grace period is, what are the penalties if you pay late, are there extra fees, extra costs, over limit fees, if you miss a payment or two, they reserve the right to increase interest and things like that. So it's the type of thing that nobody likes to read, and I fully understand that, but it is very, very important to read, just so you understand the rules of the product that you have. Last month, your credit card balance was zero. This month, your statement shows you made a purchase, you made a $500 purchase. If you pay off $400 by the due date, you will be charged interest only on the $100 left to pay. True or false? See what people say. Oh, we got a little mix here. False, true. So many years ago, it used to be true, but many years ago, banks changed this. So pretty much every bank now charge interest on what they call the average daily balance. So what that is if you make a purchase on a credit card or make multiple purchases during the month, you get your bill, you paid in full by the due date, then there's no interest. So we all know that at that point doesn't cost us anything. But as soon as you pay less than the full, then you are what we call in the industry revolving a balance. So what that means now is your account falls on basically what they call daily interest or average daily balance. So from there, what they do is they'll look at your purchases and your balance from the beginning of your cycle, and at the end, they'll average out your balance of how much you've borrowed during that period, and that's how they calculate the interest. So in this scenario, if that $500, for example, was made at the beginning of your cycle on your credit card, so you make that $400 payment at the end of your cycle when the payment is due, that means that you've borrowed that $500 for almost the full 21 to 26 days, which means your average balance is going to be a lot higher. Same way that if you would have made that $500 purchase, let's say 2 days before your statement closes, now your average balance would have been very low. So they're little things that not necessarily huge impact when we look at 1 month, but when we look at month over month, these are the type of things that can really increase how much interest we pay on a credit card. So understanding this can change some of the way we do things. And what I mean by that is most of us have been trained to pay our bill by the due date, which is at the last minute possible. Now, if you paid in full, financially, that makes sense because that means you are keeping the money in your pocket as long as possible. But if you're not paying in full, or if you're carrying a balance on a credit card, if you make that payment earlier on, well, that helps reduce your average daily balance, therefore saves you a little bit more of interest. So if you're just trying to pay down a credit card, when you get that statement, if you made that payment right away, it actually saves you a little bit of interest versus waiting another week or two and making it closer to that due date. So again, little tricks and tips that we don't always realize when it comes to some of these things. Now, again, along the way, if there's questions by anyone, just put them in the chat and I will answer them as we go. If you use your credit card to take money out as a cash advance, you don't have to pay interest on the amount you've withdrawn as long as you pay your credit card balance in full by the due date. True or false? False. Yeah, we got some false here. That's correct. So cash on a credit card is daily interest. So as soon as you take money out on a credit card, you start paying interest. So if you took $20 out off your credit card at the bank machine today, you pay it back tomorrow, you pay a day's worth of interest. So cash on credit cards typically is a very bad idea because it can be very expensive. And again, if we look at most credit cards, most have different interest rates for retail and cash transactions. Average interest rate for retail transactions on credit cards in Canada, 19.99% per year. Average interest rate for cash transaction is 21.99, so a little bit higher. And the other thing that, again, when we don't read our terms and conditions, pretty much every single credit card company does this, they use what's called sheltering. And what sheltering is basically if you have retail transaction on your credit card and you're carrying a balance, so you're not paying in full. Now you throw in a little cash advance because you needed some money for something. In those terms or conditions, there's usually a line somewhere in there that says, we reserve the right to apply your payments to the lowest interest rate transactions. So what that means is you make a payment, you're paying down on the retail at 19.99, but none of it touches those cash transactions at 21.99 until all the retail is paid off. So again, when you have those two types of transactions on a card, that's a way where all of a sudden it can cost you even more. So again, the importance of paying attention. Now, for many years, there was a lot of craze going on for promotional interest rates for cash transactions and such, which, if managed properly, could be a good deal for the member, absolutely. But you need to be careful with it to avoid these kinds of sheltering cases. Yep. So again, it's just paying attention on some of those little details because they get you to do a big balance transfer at a low rate, but a year from now that rate is done, but now you also have retail and now it's costing you extra. So again, it's not always a bad deal, but it just needs to be managed very, very carefully. Last one here. Without a good credit history, your bank may charge you a higher interest rate on a personal loan or car, house, and such. Your bank may refuse to give you a loan. You might not be able to get a lease on an apartment, A and B, or all of the above. Some answers here, all of the above. Yeah, you're correct. All of the above. So credit in this day and age is used for a lot of things. So renting an apartment, certainly from a bigger type corporation, they usually do credit checks. Even from individuals, some of them will do credit checks, so that can impact things. In this day and age, if you're on a cell phone plan, they almost all report. And those are things that, credit-wise don't weigh a lot. But if you look at renting, for example, if you can't pay your cell phone on time as a landlord, are they going to think you're going to pay your rent on time? So they don't have a lot of value when it comes to your credit score and such, which we'll talk about, but they do have importance because people will see that. Bad credit can stop you from getting jobs. There's certain jobs that if you have bad credit, you can't get hired, and it's usually disclosed in advance. Any jobs where you're dealing with money, personal information, and things like that, that if you've got bad credit, usually you won't be able to get those jobs because you become a security risk. It's just the way that the system works. So credit is important. It's used for a lot of things nowadays. It's almost impossible to live nowadays without some sort of credit, which is why it's important to understand it so we use it properly to make sure that we don't fall into some of the traps. So how do you stay out of trouble? Well, again, as I said earlier on, I have absolutely nothing against credit. It can be a very valuable tool for a lot of things. So if you use a credit card, you make purchases, you pay it in full, doesn't cost you anything. There's no interest charges or anything like that. That's a great way to use credit card. A lot of cards nowadays have points out there. So again, you make purchases, you're getting points, you paid in full, you're getting these points, you're getting something for free. Absolutely, even better that way. Now you're getting even more of your products at no cost to you. So again, fantastic. The only thing to be careful with, though, that I used to hear often is well, I don't pay it in full, but I get points. Okay, I understand that. But now if you're revolving a balance, you're paying interest rate. So now those points are not free anymore. Now you're paying for them. So it's that illusion of getting something free at that point. So it is only free if you don't pay any interest. So again, keeping that in mind. Now there's times where we might make a purchase, or it could be home repair, car repair, large purchase, something that is needed that we know we can't pay it in full. And that happens. That's just part of life. No problem with that. But the key is about having a plan on how we're going to pay it back, to know exactly how are we going to do this? And again, comes back to having that good budget. If we have a good budget, we know how much surplus we have. Therefore, we know how much money we can put on this credit card to start paying it back. And a lot of people tend to use the credit, especially with points where they make all their purchases all month long, pretty much on credit, and then they pay it in full where they don't use the money. Again, a system that works, but that's where budgeting comes into play again, because that method is dangerous in the sense that if we're not keeping track of our spending, we can actually overspend what we are expecting to, and now we don't have enough to pay it all. And that's kind of how we often fall into that trap. So again, it always comes back to tracking our spending so we know what's going where. But if we can't pay it all, again, paying as much as we can. Minimum payment is never a plan. And I'll show you here in a slide, on the next slide, why minimum payment is not a plan. They say here, if you carry a balance to get a low interest rate card, it is an option. There are some lower interest rate cards out there. There's usually two types, the most common types of low interest rate card. First one, basically you pay an annual fee and you get a lower rate in exchange, which personally I'm against, because at that point, we're giving ourselves permission to carry a balance at that point. Like I'm paying a fee, I got a low rate. So then in the back of our mind, again, this is kind of a human nature thing. Well, it's okay, it's a low rate. But a low rate is relative, right? 9, 10, 11% are what you see on a lot of them. It's a lot less than 19.99, but you're still paying something. So I don't typically care what the interest rate is on my credit cards, because my goal is always to pay them in full. And if I know I won't be able to pay it in full, then I have a plan to know how much it's going to cost me and how I'm going to pay it back. Transferring balances to a line of credit is again an option. Lines of credit tend to have a much lower interest rate than credit cards, although even those interest rates over the years have really been creeping up for some of them, that they're not that good of a deal anymore. Secured line of credit definitely has better interest. Again, as a way to save yourself money, consolidate your debt onto a line of credit so it costs you less so you can pay it down. But again, we have to be careful, because if we keep using the credit cards, all we're doing now is creating debts in two places. So again, it's about that tracking and understanding what we're doing with our funds. And then again, as I mentioned, always pay a few days before the due date just to make sure that they receive that payment in time, because we don't want to fall behind. So here's an example of a purchase. So someone needs to make a $3,000 repair purchase of some sort. Life happens. Not everyone necessarily has $3,000 on hand that they can use. So credit becomes a handy situation. Interest rate in this example, 18% per year, which is a little low based off standard. So if we look at minimum payment on a credit card, again, this information is in your terms and condition. Average minimum payment is between 2 and 3% typically, although there's talks about increasing those minimum payments for this reason that we're about to see. So at 2.5%, which is average minimum payment for a lot of credit cards, it would take 263 months to pay it off and cost $4,100 in interest. So that $3,000 purchase now costs you basically double when we start adding the interest, and takes a long time to pay. Now, if we have a good budget, we know what kind of surplus we have. We say, okay, I'm going to put $100 a month to pay this back. At $100 a month, it would take you 41 months to pay it off and cost you $1,000 in interest. Big difference from minimum payment to a fixed amount. And again, it's the power of the budget, because your budget tells you if that $100 is there or not. So if it's there, you know you can put it. The same way that if you're doing this, then okay, I had to spend this $3,000. That's not even the question. There's those types of things that happen. Now I know that based on my budget, I can put $100 a month, and this is the type of numbers I'm looking at. But I can also now look at my budget and say, you know what, I'm going to give up my coffee for the next little while because I'm spending $50 a month on coffees and donuts. And in the grand scheme of things, I don't find it that important. So now I can make 150. So now you're going to reduce that 41 months to about 26 or so, and that $1,000 of interest around 700. Again, personal decision that you can make based on having a good budget and making those kinds of choices. So again, that's where the budget can help you make those kinds of decisions to get you to a number where you're comfortable with the extra expenses. And again, nowadays with, good old Google, it has everything. Before you make this purchase, my suggestion is exactly that. You go on Google, credit card payoff calculator. There's dozens of them that'll come up. Find one that you like. Maybe save it to your taskbar so in these situations you know where it is, and you put in the information. Here's my $3,000 purchase. Here's the interest rate on my credit card. Here's minimum payment and what I think I can do payment wise. And okay, what if I increase it? What if I decrease it? It'll give you the duration, how much interest, and all that information. So now you're making that educated decision to say, well, okay, I need this. It's going to cost me an extra $1,000, but I can do 100 a month, but I'm okay with that. So, okay, I'm going to do it. But if I'm looking at $4,100 in additional interest, well, okay, maybe I'm not okay with that. Maybe I need to try to look at other options and other solutions, right? And again, when it comes to these types of emergencies and such, again, that's what we're here for through SISIP, is to give us a call, because there might be other options that we're not thinking about. So tips for managing debt. The first one is to shop around. When we talk about shopping around, especially in this day and age, like I said, the interest rate are pretty much the same for all credit cards. So when you're shopping around, it's not so much about interest rates. It's more about finding a product that you like, that might give you something that you're looking for. And everyone's different. There's so many programs out there for, points for groceries, free fuel, travel, cash back, you name it, it's out there. So it comes down to doing a little bit of research of seeing what's out there, what's a product that's going to give you something back that works for you. So it's finding that product. So again, everyone's different. A lot of them have annual fee versions and no annual fee versions. And usually the difference between the two is how fast you gain points. Personal opinion, I don't think there's a single credit card out there that's worth paying an annual fee for, because you're just giving them money for nothing at that point. So I would rather have a no fee card and earn half the points because they're free, versus I can earn more points, but I'm paying for those points. And I don't want to pay for my points. I want free stuff. So again, most products have a free version out there somewhere. So you go with the free version. Yes, you might earn points a little bit slower, but in the end, you're still actually getting something free versus something you're paying for. Keep it within your budget. So again, your budget comes down to, once you've got your budget, you've got surplus. If your budget does not have surplus income, meaning that once you've paid for everything you need to pay for during the month, if there's next to no money left over, the truth is there is no room for credit, because that's how we get into trouble. To have credit, we need surplus income, which means we got to be able to pay for everything we have. There's money left over. So now if I use credit, I can pay for it. Because credit is often used for extras. Yes, a lot of times we can use it for our day-to-day, so it's kind of a swap with our budget. But for some reason, there's always a little extra that tends to happen on credit sometimes. So having that surplus income is very important. And your budget kind of dictates what that is. So an example that I usually suggest is whatever credit card you get, whatever line of credit they offer you, in your terms and condition, it'll tell you what the minimum payment is. So if that credit card was max, figure out what that minimum payment would be. And as long as your budget has a minimum of double that amount available, then that's fair. If you can't cover double the minimum payment at a minimum, then that's probably too high of a line of credit and could be dangerous to get yourself into trouble. So I always suggest to keep it a little bit lower. And the other thing too is, as much as banks are very, very generous when it comes to lines of credit, it's just making sure that you get what you need. There's no point of having a $25,000, $30,000 line of credit on a credit card if you don't need it. It doesn't help your credit really, because now you've got a lot of available credit anyway. If someone steals your card, you are protected, but it's just that much more trouble to kind of deal with. So keep it within something that you are comfortable with and that you think will fit your needs. Again, depending on our stage of life, those needs kind of change, where for one individual, having a $2,500 line of credit might be more than enough for them right now because they don't see themselves really using it for anything more expensive than that. Versus maybe later in life, maybe 5,000 or 10,000 becomes more practical based on the use. But again, don't be afraid to tell them, whoa, that's too much. They want to give you 7,500. You can tell them, you know what, I'm okay with 25, thank you. And they have to reduce it at that point. So you own that credit card. They're allowed to offer you as much as they want, but you're allowed to get as little as you want as well. So it's just about asking them the question. Same way as we said earlier, that when they offer you those increases, you're absolutely allowed to say no to them. So keeping it within your budget and borrowing what you can afford to pay back is kind of the same thing. Again, making sure to keep those payment on times, because again, credit cards is probably not probably is the one tool that can build your credit the quickest. And it's also the tool that can destroy your credit the quickest, because a credit card is an open loan that we can borrow on at any time. If we manage a credit card well, then it's really good for our credit score and credit information. But if we don't, then it really hurts our credit score and information. So it's one of the tools that can help or destroy our credit depending on how we manage it. So always making sure that we pay it on time. If we're carrying a balance, again, you can make multiple payments during the month just to help reduce your balance quicker, save you on interest, reducing that average daily balance. So you absolutely can make payments as often as you want. The key is to try to pay it off as quickly as possible to save you interest rates. Excuse me. Quick one on student loans here. There's a lot of programs for help when it comes to student loans in Canada as well. So it's just good to know that, a lot of times we finish school, maybe the income isn't there to start paying. There's what they call the Repayment Assistance Program, or RAP for short, that depending on each individual's personal situation, as far as single, family and such, and household income, they can put those payments on hold. The key with student loans is to stay in communication with CanLearn, which manages the student loans, because when they go delinquent, then you lose options. If you stay in communication with student loan services, there's all kinds of programs that can help to ensure your loan doesn't go behind. The interest rates are not terrible, so putting those payments on hold, it's not, it doesn't cost you too much, and it opens option, because they don't necessarily, or most usually, call people a lot and get on them because they're behind on their student loans. But the issue is eventually it just ends up in collection. And now you lose a lot of assistance options that are available. So the key to this slide is simply this: don't ignore student loans. You have student loans, you don't know what you can do. Again, give us a call. There's options for different things that can be done just to, again, help protect your information, because student loans are government loans. They have a lot more rights than banks do. So you are also putting yourself at risk at that point, because there's things they can take that banks can't. little bit about credit bureau information. So getting a copy of your credit report is a good way to check for identity theft. The only way to know if your report is accurate, free of charge if you request your report to be sent to you by mail, or all of the above. A chance for people to pick an answer. Yeah, looks everyone's got that. So yes, all of the above. And nice thing is nowadays there's even easier ways to get access to your credit file. Now, there's a couple of sneaky ones out there with a lot of financial institutions that offer people free credit checks with their accounts or free for a year, and then they start charging you for it. So you got to be careful. And what they offer you is not necessarily your full credit file either. So there's some ambiguity. I've seen different things from different banks. Um, but you absolutely can get access to your credit file online yourself directly for free. And I'll give you the links a little bit later on, but there is creditkarma.ca and borrowwell.com that offer you free access to your credit file. The reason it is free through them is because you sign up and then you see credit card advertisement, you see commercials. That's how they get paid. We see commercials everywhere we go in this day and age, so it's not terribly hurtful. I get one email from them once a week because before I recommend anything to anyone, I will sign up for it myself. I've been signed up with these guys for probably 6-7 years now. And before doing so, I vetted them and they are absolutely legit. So there's no concern there. And it gives you full access to your credit file. So Credit Karma gives you TransUnion, and Borrowwell gives you Equifax. Again, in Canada, those are the only two credit files we have. In the US, there's a few additionals as well, but in Canada, those are the only two that we have. And that will give you access to your credit file so you can see what's there. The other thing I like to talk about here is the whole credit score thing. We see a lot of advertisement. There's a lot of emphasis put on credit score. People need to remember that a credit score is an indicator, because the credit score from Equifax and the credit score from TransUnion right off the bat is not going to be the same score because they calculate differently. They're two different businesses. So they do their own twist because everybody thinks they do it better than the next. And then when you deal with your bank, well, every bank has their own score system as well. So they'll take the Equifax or TransUnion information, and then they start overlay their own information on there for the type of people they like to lend to, and kind of create their score and kind of present it sometimes as a FICO score or Beacon score. And there's so many different names out there, and they're all a little bit different. But in the end, the key is this: those scores are all indicators. The fact that you have a really high score doesn't guarantee anything, because we could all reach that limit. Yes, you have a great score, 800 plus, you've got a few credit cards and loans, maybe you've got no balances. You go somewhere to take a loan and they refuse you. Probably because at this point, although you're not using the credit, it's there and it's available. That counts against you, because tomorrow you could go rack up all those cards. So we all have a limit of credit that we can have, which is why having too many credit cards with huge lines of credit available, especially if you don't use them, can actually hurt you if you go for something else somewhere. Because now you're going for a loan, let's say for a vehicle, they're coming with a high interest rate because you've got all this available credit. So now you're becoming risky. So again, it's about having what you need, not what's necessarily being offered out there. Just keep it within what works for you. If you have applied for several credit cards or other forms of credit within a short period of time, this could have a negative impact on your credit score. True or false? True. Yep, absolutely right. And this came to light some years ago for a few different reasons, where some new banks came into Canada. They did things very differently, where they offered gifts for people just to apply for a credit card. A few of them were doing this. So people were applying for these credit cards because everybody loves a free gift. And everyone kind of got into this game. So it doesn't matter what store you walk into this day, you're usually being offered a credit card, right? Canadian Tire, Walmart, I think Shoppers too now. Just about most big stores, you walk in, they're offering you that credit card, and they'll give you a gift just to apply for it. So people just kept applying for these cards everywhere they went because they want the free box of cookies. Well, the problem is that was starting to hurt your credit score, because now, next thing you know, in a 12-month period, someone had applied for 6, 7 credit cards that they don't even want. So you got to think that every time you do that, you are hurting your credit score. So there's a very easy way to stay out of trouble when it comes to this. It's simple. Apply for what you want, not what you're being offered. If you want a credit product of some sort, you apply for it, they're going to do a credit file. It's going to ding you about 3 points on your credit score for a few months, which they'll come back, no big deal. And that's it. But every time you're out there and someone's offering you a credit card, if you don't even want the product, whatever the gift is not worth it, because now you're hurting your credit for absolutely no reason. And then you got to think, once you receive that credit card, if you get approved and you don't want it, now you got to call to close it. Because if you just kind of leave it there open, now it counts against you as available credit. So again, whatever the gifts are, they're not worth it. If you want the product, go for it. Absolutely. But otherwise, gifts are never worth it. Which of the following does not affect your credit score? So your payment history, whether you've ever missed a debt payment, any collection of bankruptcy that has been recorded against you, your history of repaying installment loans from family or friends, any outstanding debt you have, or your account history, how long you've had credit, and the type of credit. I think that's an easy one, right? Exactly. See, families and friends, those don't get reported. Everything else is what we find on a credit bureau, basically. So the type of credit, 18 months typically of payment history to make sure that you haven't, paid late or anything like that. Collections, bankruptcies, proposal will all show. And how much you owe and so on. It's always important when we look at our credit file, though, to look at things like reported date, because sometimes people look at something and say, oh, this is wrong. Okay, but it hasn't been reported for 3 months. So what they're showing is information from 3 months ago. Oh yeah, 3 months ago, I hadn't paid that off yet. Because there's no obligation for banks to report to credit bureaus. They do it for themselves because it helps them as far as being able to lend funds, but there is no obligation. So banks do not have to report to credit bureaus. What they do report, it has to be the truth. So they also can't lie about what they report. So other types of loans that are out there, we talk a lot about credit cards because it's like one of the most common use product. And like I said, it's the product that can really build or destroy your credit. But there's definitely a lot of things. Sorry, there was a question. Are there debit credit cards that are straight credit cards? Okay, so a debit credit card is not a credit card. So most banks have these debit credit card nows. So basically the debit card has a credit card number, and it gives us the opportunity to use it online, for example, to make purchase as if it was a credit card, but the money's coming straight out of your bank account. So it is not credit. That is debit in a credit card format. And that's a good question. Sometimes people kind of confuse those, but a debit credit card is a debit card, just with credit card functionality, if that makes sense. So other loans, so mortgages, obviously big ones, usually for larger amounts. Car loans, lines of credit, overdraft protection is a credit. Payday loans and personal loans. So those are the main typical types of loans that are out there. Each one of these have different costs to them, though. So if we look, for example, payday loans, the worst thing that exists out there, just to show you an example on a 14-day loan for $300. So borrowing from a credit line for 14 days would cost you on average, based on average interest rates for credit lines, about just under $6. All right. Overdraft tends to be a slightly higher interest rate, so about $7.19. Cash advance on a credit card, which is 21% annual interest rate, $7.42. But the danger about that one is not necessarily, it's not necessarily a question of the interest rate, it's more about the sheltering, because that 742, if you've got retail purchases hiding that, you're never going to get to that $300 purchase until everything else is paid off. And then we look at a payday loan, $63, again, for 14 days. So those payday loan places are, I don't know what to say. They're extremely expensive, and I understand why, sometimes people feel the need to go to them. But again, being part of CAF is where we are here for, through SISIP, support our troops. There's other options available than looking at payday loans. So, there's emergency situations and things, give us a call. We can see if there's something we can do to help, to avoid going to these types of places, because they are beyond expensive. And what we tend to see with these places, as soon as you take a loan, it becomes a cycle. Because you get your loan, you got to pay it in full in 30 days. So in 30 days, you pay it in full, but now that just took a bunch of your money. So now I need to take a loan again because I don't have enough to manage for the entire month anymore. And it becomes that cycle. So that can become very, very expensive and get people into trouble when it comes with that. But the great thing about CAF is you have options, and we are one of those options. Give us a call. We can see if we can help you. We can see if there's other products that are available to help you with that buying, to avoid these kinds of places. And if you already went there, you already got those loans, all right, that's okay. Give us a call. We might be able to help you get out of that cycle as well. Because again, there's products that we can use to help you get out of that lending cycle as well. But the big key is very, very expensive. Definitely try to stay away from those. So recognizing the danger signals when we look at credit. So when we start using credit card as a necessity, because a credit card in theory, it was built as a convenience tool to not have to carry as much money with us, especially when looking at larger purchases. Most people don't come in with $600-700 cash anymore to make a large purchase. You use credit. It's easy, it's simple. I don't have to bring all this money. Some people still do, but again, that's where credit becomes that convenience piece. But when we start depending on that credit card for our day-to-day living expenses, because there's not enough money, that's a danger sign there. Because if there's not enough money today and we compensate with the credit card, odds are that tomorrow and the day after, there's still not enough money and we're still compensating on that credit card. And eventually that balance starts growing and growing and growing, until we usually get to the point where now that credit card's maxed out. I can't use it anymore. Now there's still not enough money to pay for the day-to-day, but I'm out of credit and now I can't pay the credit card. And that's where the financial problems really start. So again, it's human nature. No one sets out to do this, and human nature is, well, something will come up, or I'm working on something. And again, we all get that. But before we get to that point, again, give us a call. Maybe we can find a better solution for you. Using credit cards, cash advance for living expenses, we start missing payments or due dates is usually an indication that there might be some financial difficulty. When we're near the credit limit on most of our cards, that's something that also really impacts your credit score that most people don't know. People really got advertised and told about, if you apply for too many cards, it hurts your score. But the bit that they don't tell us is when we're up to our line of credit, that really impacts us negatively as well. So typically, anytime you exceed 60% usage of your credit card, that starts to impact you negatively if that balance stays there month over month. So you should always try to keep your month over month balance under 60% usage, because the higher that usage and it stays there, that in turn means you now start becoming a credit risk, and your score starts to get impacted as well. So just something that is good to know. Start to borrow from one card to pay the other. So paying one credit card with another credit card, usually a sign of potential financial issues as well. Transferring balances often can be a sign of that as well. So again, it's just being careful of recognizing those signs. And like I keep saying, the nice thing is for all of you, you've got an option that's not available to most, is us. We're here to help you with these things and try to figure ways how to take that control back. So how to take control of your debt if you have various debts and such. First thing we say is, to use savings to pay off balances. And here's the reason why. Now, if we go back 30 years ago, your savings account made more interest than the credit card was charging you. So it actually made more sense to keep your money in your bank account to make interest and pay a little bit of finance charges because you made more with your bank account. But unfortunately, as we all know, those times have gone away. So now your savings account, pays you 0.5%, 1, maybe 2 if you're real lucky in a TFSA somewhere. So you're not exactly making a whole lot of money versus your credit card is charging you 19.99. So when it comes to credit and money, I mean, it's a very personal thing. That's something that absolutely we all understand. And there's that gut feeling sometimes where sometimes people like to have money in their bank account, and seeing that money there makes them feel secure, and completely understand that. But we also need to understand that that money right now, if you're carrying a balance on credit card, is costing you money, because you could take maybe that $500 in saving, throw it on that credit card. So now you just reduce that balance by 500, which means now you're saving yourself on interest. If that 500 was for emergency, well, you just liberated $500 on that credit card. So if an emergency actually shows up, can always go back to the credit card. But if nothing happens, now you're just saving yourself interest as far as those charges, and you can continue to try to pay down. Once you've paid off your credit, then you can start rebuilding those savings. But anything that's just a savings account that's not really gaining you much, even looking at investment, depending on what you owe on credit versus what your investments are, that's where you got to start looking at, well, what's my return here? What's it costing me there? So sometimes, as much as it hurts, might be worth kind of taking something out to pay down all the credit, because then we can rebuild those savings and investments, and where those returns are actual real returns in that case. Because if you're paying more in interest, those returns are fictitious. I'm making $5 here, but I'm spending 10 there, right? So it doesn't work. I had a question. So once you pay off your credit cards, lines of credit, how long does it typically take? For credit score to rebound, it's a hard question to answer because it depends on everything, right? It's not just paying one off, but definitely as you lower balances, on a monthly basis, you'll start seeing the score regrowing and changing on a monthly basis as things starts to pay down. The other big thing about fixing credit, which I've run into many times, is we can't fix credit when there's something wrong with it to start. And what I mean by that is you can get a credit cards and loans and pay them great because you're trying to fix your credit, but you've got 1 or 2 collections unpaid showing on your credit file, but you're not fixing anything because you're trying to fix it, but this keeps pulling you down. So nothing's really happening. So to fix credit, first you got to fix everything that's wrong with it, and make any corrections if there are mistakes. There's ways to do that. If there's collections, unpaid bills, making sure those are settled, paid, whatever option is available to take care of them. And once that is done is when we can now start rebuilding credit, because we cannot build credit when there's bad stuff still showing there. And bad things don't go away. Right? That's another big misconception when it comes to credit. People mistake, the 7-year rules and so on. Oh, after 7 years, it disappears. When it comes to credit, if it's not paid, nothing disappears. All right, I say nothing. It can happen, but I wouldn't count on it. And the same way that it might disappear, it can show up again. So the only way to know for sure that something is not going to be a credit issue, it's to know that it's paid, closed, settled, taken care of. That's the only guarantee you have there. Because if there's still a balance owing, you owe it. It's not going to disappear. Now, yes, there is rules. And here's one of the rules, for example. So if you have a credit card or a debt of some sort, you stop paying them. After 3 years of no payments, they can't come after you legally. So they can't garnish your income, and you can't do any of those things. They've lost those rights. They've taken too long. Absolutely. But that doesn't mean the debt goes away. From there, usually ends up in collection, and then it gets sold from one collection company to the next, and it'll continue to show up. and they have the right to continue to try to collect, which what that is simply calling you constantly and annoying you. Another tip when it comes to that is collection companies are only allowed to call you, especially in Ontario, for example, so many times in a 10-day period. If you don't answer the phone, though, that does not count. The fact that they let your phone ring doesn't count as a contact. You need to talk to them. So if you talk to them, then they're only allowed to call you 3 times in a 10-day period in Ontario. That's the rule for collection companies. But again, voicemail doesn't count. You have to talk to them. And when you talk to them, simply be honest. Depending on the scenario, if you don't have the money to pay them, you just tell them, I can't pay you. I know I owe it. When things will change, I'll let you know. Don't make promises of payments that you're not going to follow through on. And the other thing you got to remember is as soon as you make a payment, you now reactivate any of their legal rights. So if you hadn't paid them in a few years, they lost legal right for garnishment, you send them $1, now you reactivated their legal rights because you acknowledged the debt. So key factor is, big myth, debt does not disappear. I would never count on that happening. Yes, it can happen, but I wouldn't count on it. And you can't fix credit until everything is actually settled and taken care of. Okay? So again, we talked about using savings to pay off balances, pay down highest interest rate debt first. Again, financially, that makes sense, but there's always an exception to every rule. Again, those are things that we can help you with and guide you with. Financially, this absolutely makes sense, but at the same time, sometimes there's just a little debt that, I can have that paid off in 2 months if I put more there instead. And there's that, just personal feeling of, all right, one's out of the way. I feel better now. Okay, now I'll go back to work to the high interest rate. So again, financially, the statement is absolutely true that paying the highest interest rate first, but then we also look at human nature, and how we are and how we react to things. And we also know that, just getting one off the table paid that we don't have to worry about makes us feel good, gives us encouragement to continue to work on these things and such. And again, those are things that type of decisions you certainly can make yourselves, or we can assist you with to try to figure out, hey, here's what we propose. Make sure that it works for you. Switching to less expensive credit card, like I said, not tons of option there. Calling creditors to negotiate lower rates, it's always worth asking, but the honest truth is most of them don't, especially if you're current. Most creditors only start negotiating when you start falling behind 4, 5, 6 months, then they'll start negotiating a little bit. So, and again, for most, I'm generalizing, some are better than others when it comes to this, but the key is to simply ask the question. So you call, you pose the question, hey, can we do something? Are you willing to, I can't make these payments, see what they have to say. A lot of this is about understanding ourselves. So if credit is a temptation for you and having them on you tends you to make you spend more than you'd like, don't bring them with you. Leave them at home. Put them in a secure place. Right? They say avoid the buy now, pay later offers, which again, generalizing for most individual, these offers are great. Absolutely. Buy now, payments starting in 12, 18 months. Problem is the interest rate on these types of retail purchases tend to be even higher than credit cards. So average interest rate for these are 26 to 28.99 per year. And again, for most individual, you buy now, later shows up. We didn't save the money, so now we start doing monthly payment at a very high interest rate. Now, if you're very good with your money, you're good at budgeting, you buy now, you start putting money aside every month, later shows up, you paid in full. Great deal. Absolutely. It can be done. But in general, for most people, it doesn't tend to work that way. So a lot of this comes down to us being honest with ourselves, making sure that this is the right decision for you and that you're able to manage and work, in conjunction with what the deal is. Last but not least, they talk about consolidation loans to make, low interest payment. Again, for most individuals, consolidation loans from traditional banks pretty much don't exist anymore. You go to a bank to ask for a consolidation loan to pay off all your debt. They'll tell you you've got too much debt and you don't qualify. And the answer is, well, I know I've got too much debt. That's why I want the loan. They just don't do them anymore because of the risk behind them. Over time, they've really stopped doing them. Now, we used to offer them through BMO, through CAF banking. That program recently went away, but again, with Support Our Troops, we've got other programs available. So again, there's a debt load, things are difficult or tight, give us a call. We might have something that can help you, similar to consolidation type loan. We have distress loans, small preventative loans. Again, all these products through Support Our Troops that we work with that nobody else have access to except the CAF population. So again, these programs are there for you, and we're there to make sure that that's going to be the right answer for you. So it's good to know that you have those options available. So when it comes to debt, what are the typical average individual options? Well, there's three options for four options. The first one is for you to do it yourself, which not everyone can, and sometimes we get ourselves into a situation that this just doesn't work anymore. One of the option out there is what they call financial counseling. Now, financial counseling, I came from this world originally, not a bad world at all, but you got to be careful because there's two types out there. There's for-profit and non-profit. So for-profit, you always want to stay away from because they charge you a lot of fees, they get paid first, and some of the things they do are definitely questionable. Not-for-profit financial counseling, great organizations, they're there to help people, absolutely. Sometimes that option doesn't work. Next option up is a consumer proposal. Consumer proposal is done with the trustee. And what they do basically is they offer settlement amounts to your creditors. So based on your financial information, they'll figure out, here's what you can afford to pay and make an offer to all your creditors. It does impact your credit, but you can fix it. And then the worst case scenario is the bankruptcy option, which is again done with a trustee. So both of those are the only two options that trustees offer, is consumer proposal or bankruptcy. That's all they do. Bankruptcy is not the end of the world. Life happens, and there's times where bankruptcy is the best option financially to get out of a place that you just can't get out of otherwise. Nobody goes out typically with the idea of, well, I'm just going to spend like crazy and go bankrupt. Okay. And my many years of financial counseling, I have never seen that in my life. Most common reasons for bankruptcies: loss of employment, illness, separation, divorce are the most common reasons. And again, it's fixable. So first-time bankruptcy, assuming no surplus income, and that's chart-based, so based on how many people in the home, what's the total household income, the chart tells you if there's surplus or not. So no surplus first-time bankruptcy in Ontario and most provinces is a 9-month process. You're considered bankrupt for 9 months. You got to make your payments. You got to attend 2 credit counseling session and submit proof of income for the first 7 months. As long as you do that, month 9 shows up, you get discharged from your bankruptcy. You're no longer considered bankrupt, and now you can start rebuilding your credit. Consumer proposal typically are 5-year deals. So again, it's a 5-year repayment plan. But the nice thing about that is once the plan is signed, that's the deal. So let's say off of all your debt, they reduce your debt load by about 40%. And you now need to pay back, $15,000. Everything's been signed. You're paying $300 a month. Tomorrow you win the lottery. You can pay them off. Proposal's over. No impact. And like I say, financial counseling, they offer payment, repayment, debt management plan as well and such. But before going to any of these people at this point, you should call us. So again, as a financial counselor with SISIP, that's what we're here for, to figure out, what is the best option for you, and looking at the options that we have that the rest of the world does not have, to see if we can help you out of this bind. Now, it doesn't mean that these options are not still available. And even when we look at the information, we might suggest, like, what we have here, doesn't work. But in your case, maybe financial counseling might be able to do something for you that we can't. The same way that, you're at the point that consumer proposal or bankruptcy is the only option that we see as viable, and we'll guide you through that process to say, here's our suggestions, here what it means for you. I'm a certified bankruptcy counselor, so I know, in Ontario, know the ins and out of how that works and what are the costs. So we can help you through the process. It is a scary process for a lot of people, when you've never been through it. It's understandable, but in the end, it's really not that bad. Okay, and it's absolutely fixable. You can get your credit back to normal once you're done a bankruptcy. 12 to 18 months, assuming your finance can support it, you can have your credit back to normal. But that's a first time bankruptcy. Second time is different. Third time is also very different. And then you hear the stories of so and so went bankrupt 5 times. That's impossible, because in Ontario, anyway, in most provinces, you can only go bankrupt 3 times in a lifetime. Personal bankruptcy. That's it. After the third personal bankruptcy, first of all, no one will ever give you credit again unless it's fraudulent, and you can't go bankrupt again. So it's a 3-strike system, basically. So again, a lot of stories, a lot of misinformation when it comes to these things, and a lot of times it's because people don't know, the details. Well, so and so went bankrupt, but he kept everything. Well, there's reasons for that. It's because he doesn't own any of it. It's all finance, so he doesn't actually own it. Versus so and so lost everything because he owned it all and didn't have a choice. So there's a lot of things, and again, that's information that we can help with because this is what we do. So before seeing any of these people, then give us a call, because then we'll make sure that going to them is the right answer or not, or we can help you with things that we have available for you. As promised, I'll put up on the screen here, I have the website to access your credit files. So for the Equifax version is borrowwell.com, and then for TransUnion, creditkarma.ca. So those give you access to each one of them. So you sign on, basically sign up with an email address. They ask you various personal questions to make sure that it's you. They both pull their information directly from Equifax and TransUnion. They just put it in a format that's easier for the average individual to read. They've actually done a really good job that they make it pretty easy. Now, they like to play around with their website often, things change, but you basically find the See My Credit Report button to click, and then you can see it. And even if you have access to this and you don't quite understand what's showing there, again, happy to help you. Give me a call. We can look your credit file over with you so we can see what's there. How does it show? I had a question here: how often should you check your credit rating? You should check your credit file. They say typically they say once a year, but I say that with a little bit of a caveat. I mean, if you're not moving around, you've been living at the same place for years, you're not applying for credit, checking every other year or so is probably fine. If you're moving around a lot, and you keep changing addresses and so on, then there's a risk, right? Because there's always a piece of mail we forget to change address on somewhere, so that means someone's possibly getting our information. So definitely checking it, at least once a year is a good idea. But if you're signed up with these guys, you can check it whenever you want. I mean, like say I get an email once a week, every 2 weeks. That's about it. So once in a while, I actually open it just to go see, what's changed. But this gives you instant access anytime you want it. If there's bizarre activity, they will send you notification. We've noticed something new on your credit. Well, that might trigger you to go have a look at that point. Things to think about when it comes to credit file. Again, if you've never checked yours, definitely a good idea to check it. There's a lot of mistakes out there. It happens. Mixed files, people with the same names, juniors and seniors, where these files get intertwined. I've seen it with my brother and my father, both have the same name, and their file's a total mess. Luckily, they both have good credit, but their files are completely, mixed up. I've seen it with twins where their files were mixed up, different names, but also very close, same date of birth. So now they think it's the same person, but it's actually two individuals. So it's good to check, have a look, see what's there, make sure that everything that's on there is yours. Again, they report a rolling 7 years. And what that means that if you have a credit card product, you closed it, zero balance, you're not using it anymore, it will disappear off your file in 7 years. After that, you just won't see it anymore. Okay, but it has to be closed, it has to be paid off. I had a question here. Should married couples have individual credit versus all joint? Good question. It's a tricky one though, because there's some personal bits to that, but financially, you should definitely at least each have one under your own name. The issue of, and especially if we go back again, 30, 40 years ago, used to be that credit was usually always in one person's name, usually the husband, which means the partner had no credit at all. So when something happens to the other individual, now they have nothing, which in today's world is a big problem, right? So you can absolutely have joint accounts. So if you're jointed on an account, it means you're both responsible for it. But you should have at least, I would say, one credit card individual to each of you to create your own credit. So just safer to have, at least one to build some of that credit up. Because yes, it's an area that a lot of people get themselves into trouble and realize that they have no credit.
Martin, I was just asking that question only because I think we talked about this before, that, my husband and I made an investment purchase, and on the loan application, the loan officer actually left my name off of the loan application, and it's only in my husband's, because she said our interest rate would actually have been higher if my name had been added to the application, the financing application, because it showed that I had no credit.
Yeah, and
So
that can absolutely happen, and those are the type of things that happen where now all of a sudden it's well, you have no credit, so that makes it worse, so we'll leave you off, which, but depending on the what, can be a good and bad thing, right? So it's
right. And I only brought that question up only because to me it was a complete surprise, thinking, we've had, my husband and I have been joint on a lot of things, whether it's been homeowner line of credits or whether it's been, loans in the past, and we've always been joint, both names. So my assumption had been that that would mean that my credit was sort of tied with his, and was as good or not as his.
yeah.
But apparently that's not the
Well,
case.
and that's because in the banking world, the whole joint account thing is a bit misleading. Yeah, you would think that joint means both responsible, both are, get the benefit of it. But even in a joint account, you have the primary holder and then joint is whoever else. So the whoever else, the only thing that they are is financially responsible for it. A lot of banks used to not even report joint accounts. So it would only get reported to the primary individual. Some now report to both, but a lot still just report to the primary holder, and it says joint. So, okay, it's a joint account, but it only reports to the primary. So, but yes, and that can absolutely happen. So it's good to establish your own credit as well. All right. Any other questions? Well, that was an excellent one there. So we're up to the question part. Are there any little bits and pieces that curious about I might have missed on, or clarification, or?
So Martin, I presume on that question, the primary account holder is always the one with the income. It doesn't matter which way around, or which way around the names are on the account?
It depends on how the person fills out that application form. So usually the first name on the application is the applicant, and then whoever comes after will be either an authorized user or joint.
I'll have to check it.
Yeah. And it's hard because, again, I've worked in the banking industry for many, many years. And a lot of people don't always know the difference between being an authorized user on a credit card. So an authorized user means you're allowed to use the credit card, but you have no financial responsibility, versus a co-applicant isn't now financially responsible for it as well. And even some of the bank tellers don't know the difference. Like, you call them and it's like, you ask them, am I an authorized user or a co-applicant on this card? And they don't know. So it gets a little bit tricky.
Secondary card holder, then, on, say, a credit card account, secondary card holder would be?
Again, it depends on the bank, on it's all terminology, right? So for some, a secondary card holder is a joint account, is a secondary card fine. So it's always about asking that question of, am I just an authorized user, or am I responsible for this account as well or not, right? And it gets tricky. And I've seen some messy situations for that where people thought they were one, but they're the other. And it's very difficult to get your name removed. So if you have a joint account, most banks are not willing to remove a name. They'll rather close that account completely and then have each individual reapply for their own, because they don't want to give up that liability. Well, right now we got two people we can go after. Why would we change it to one? So they make it harder than it needs to be. Now, if there's no balance, they might work with you a little bit more, but as soon as there's a balance on there, they pretty much won't do it, because they don't want to lose the access. Good question. But yeah, it is a little murky sometimes. I'll answer any other questions. I'll just put up my contact information, so that way if anybody wants to get a hold of me for any questions, comments, or anything like that, they can have that as well. I've got my direct phone number and email there, or we can be reached through the 1-800 number for SISIP as well. And again, if it's just questions, things people are not sure about, absolutely, that's what we're here for.
I have another question, Martin.
Mm-hmm.
We have a problem right now with our cell phone company. So we were charged in error quite a lot of money. So everybody's said it's not our fault, but getting it sorted out, they're not as fast to put the money, like to credit the account, as fast as they were to debit it, if you get what I mean.
Yep.
So how long is it? You mentioned that cell phone companies are quite good at reporting. How long would it be before, I mean, we don't actually have any credit in the US. We don't have a credit card or anything. So I don't know what they could do, but they tell me right now that that amount is suppressed. Does that mean it doesn't count against anything?
Insofar as credit?
Yes. Is it a US phone?
Yes.
Okay. So in this case, I mean, you applied for the phone. So in theory, you would most likely have some US credit at this point, but not much showing if it's just a cell phone. So the impact's minimal. It's suppressed, which means they should not be reporting it as delinquent or anything like that. But depending on whose name is on the phone, you could look up to see if you have a US credit file with creditkarma.com instead of .ca. That will pull the American version.
Oh, okay. Thank you.
Borrowell gives you the option as well for Canada and US as well.
Okay, thank you.
But yes, and again, it doesn't weigh a lot. Now, if that's all that's showing and you were going for some US credit and the only thing showing is a delinquent cell phone, certainly wouldn't help. But outside of that, it won't affect anything on the Canadian side. US credit, Canada credit, other country credit, they're all separate.
Okay, perfect. Thank you.
You're welcome. Good question.
Okay, so if we don't have any other questions or anything like that, I will stop the recording here just after I thank Martin for joining us for this second session of 3. And so I invite everybody to come back for the 3rd session next week, which, Martin, remind me what next week's session?
We're going to talk about saving and investing, a couple of tips and tricks on how to save, and again, services that are available. And again, I just can't say it enough. For all the CAF population, so many more options through SISIP. Again, if it's even just a question, just give us a call. That's what we're here for. We're happy to help.
Perfect.
Where do we find the recording, Kim?
So I think we're going to hang on until after the 3rd session. And I think my understanding is that Joanna's going to, once the editing is all done, she's going to kind of marry them all together in a 3-part session. But they'll be available on, the link will be available on the CAF Connection website, and it will be directly, I believe, through our YouTube channel.
Okay.
Yeah, but typically if you go to CAF Connection and go under the resource button, it will give you a tab there to hit for the YouTube video channel. and it'll take you right to the MFS US YouTube channel, and there's a whole host of great sessions and presentations there, and my understanding is that these will be one of them.
Okay, cool. Because we might not be able to make next week's, but there's also some family members that would hugely benefit from your advice, Martin. So I wanted to share the link with them.
Perfect. So what we'll do is yeah, we'll make sure that once they're all married together, Joanna will post those, and we will most certainly make sure that the information goes out so that people know where to find those recordings.
Thank you.
You're welcome. Okay, so Martin, thank you so much again for taking the time. This was a great session. Look forward to next week's, and we'll end the recording now.
Awesome.
Thank you,
Bye-bye.
Martin.
You're very welcome. Glad